Dear students, today we are going to learn about the financial accounting. I, Amit Kumar Goyal, Assistant Professor in the Department of Business Management in Integral University, going to teach you about the basics of the financial accounting. The topics which we are covering to the today's session is meaning and definition of bookkeeping, features of bookkeeping, objectives of bookkeeping, meaning and definitions of accountancy, branches of accountancy, basic accounting technologies or the basic terms of accounting, and concepts and conventions of accounting. When we are going to learn about the accounting, the basic thing is to know what is the bookkeeping. A bookkeeping is a process of recording business transactions in the books of accounts in a very systematic manner. The point to be underlined over here is the recording of the transaction in a systematic manner is known as a bookkeeping. The various authors or the various accountants has given a specific definitions of the bookkeeping. Like the first definition says that bookkeeping is the art of recording business dealings in a set of books. Why we are using the bookkeeping as an art? Because here you have to show your creativity how beautifully you can record the business transactions in a meaningful manner so that you can by just seeing the proper books you can analyze and understand what is there in a proper transaction. The another definition says that bookkeeping is an art of recording in the books of accounts the monetary aspect of the commercial or the financial transactions. The second important thing is that which covers in the definition is that we will record only the commercial or the financial transactions. This means that if the transaction does not have any monetary value or anything which cannot be expressed in money will not be found the place in the books of accounts. Now, which will come the features of bookkeeping. It is a process of recording business transactions. First thing is that we will record only those transactions which are related to the business. Anything which are done out of love and affection or anything which are done on a personal basis will not be recorded in the bookkeeping. Money transactions are only recorded. The things which are expressed in terms of money or there is some medium of exchange like money will record these transactions in a proper bookkeeping. Recording is made in a given set of books of accounts. The recording of the transactions which took place in the accounting or a bookkeeping will found a place in a specific set of books which we are going to discuss in a later session for a specific period. When we are recording the transactions are only recorded for a specific set of period. That means the transactions are recorded only for one financial year, which means that a period which starts from 1st April and ends on 31st March of the next year is known as financial year or an accounting year. It is not at all mandatory to record the transactions only from the March to April to March. It depends upon the organization or the business how he wants to record the transactions. But for the accounting point of view, but for the taxation point of view, or for the government point of view, we will use a specific set of period which is from the 1st April to the 31st March of the next year. Art of recording business transactions scientifically. Uh, when we are saying that art of recording means that how creatively and how beautifully we will record the transaction in a systematic manner so that we can just see the transaction and we will understand what is there in a particular statement or in a particular transaction. If we are talking about the objectives, what is the purpose of recording the keeping the making the bookkeeping or recording the business transaction? That is permanent record. The first thing is that it is a permanent record. Once you record the transaction, it will be available as and when required for a longer period of time to know the profit and loss. That is a very important. When we are talking about the business works only on the philosophy or on the concept of profit. No business will be doing not to earn profit or for the charity. Though there are certain business which are for the charity, but 90% of the business transactions are done only with a purpose or a motive to earn profit. To know the total amount of capital. Here we will know how much capital is invested in the business and how much money we have received in future against the money invested in the business. To know the assets and total assets and liabilities. The assets and liabilities are the two main parameters which shows the or reflects the true financial position of the business. To know the process of business. When we are preparing all these statements or accounts, then we are in a position to know the progress of the business. If the profit is higher as compared to the loss, we will consider our business is going to earn a huge profit and it is going in a right direction. If the assets of the business are more than the liabilities, then it means that the solvency of the business, the profitability of the business is better as compared to the debts which are going to be paid off in near future. To know the legal requirement and tax liability. When we are preparing the accounts, we are keeping the bookkeeping, making the bookkeeping, and in a systematic manner, we will came to know how much how much tax we are going to pay in a current financial year. And if some uh, court matter happens, or if any person has filed a suit against the organization, then we have a legal document which can be produced in court to prove our point. So when we are going specifically now, we are coming to the accountancy. What is the definition or the meaning of accountancy? Accounting includes bookkeeping, classifying, summarizing, interpreting of the business transactions which are of financial nature and interpret the result thereof. If we if we see all these words, these are the unique words of accounting which covers the entire process or entire things of the accounting. Bookkeeping means recording the transaction, then classify each transaction gets classified according to the nature of the transaction. Summarizing is a language of accountancy. We are going in the detail in the coming sessions, but in short we can say that summarizing is is general entry, because when we are talking in a simple English language or normal way of talking, that goods sold to Mr. A, this is a normal transaction which occurs in the business during the during the financial year. If we record the transaction in such a manner, then it becomes difficult to record all the transactions, and you can't imagine how many books will be filled in a year, in a month, or in a week if we record the transactions like this. So we have to make this long transaction into summarization form or in a general entry form, which gives the true reflection of this long statement. So we have covered bookkeeping, classifying, summarizing. What transactions are recorded in this? We record only those transactions which are of financial in nature. That means if there is any monetary transaction has occurred in the business, we will record only that transactions which help the business to earn profit. And the last thing or the very important thing is that the interpret the result thereof. Interpret the result thereof. The meaning of this is, at the end of the business transaction, we will record, we will try to analyze whether we have earned a profit or loss in the business. So till here we have covered the basic things. Now we are going accounting by definitions of accountancy by the various authors. Accountancy refers to the entire body of theories and the process of accounting. The same thing that we have covered in the previous definition, the same thing over here is that it is the entire theory and the process of accounting, how we will record the transaction and how we will get the result. The another definition is n- nearly every business enterprises has an accounting system. It means collecting, summarizing, analyzing, and reporting in a monetary in terms information about the business transaction. The same thing that as I've explained in the previous definition, the same thing conveys over here, that the most important thing is recording, summarizing, classifying, and analyzing or interpreting are the more the same thing of the business transactions which are of financial in nature. Now, the most important thing when we are talking about the branches of accounting, there are broadly classified, there are three types of accounting: financial accounting, cost accounting, and management accounting. Financial accounting means where we are simply calculating the profit and loss of the business transactions occurs during the previous financial year. The cost accounting is that accounting which helps us in determining the cost of product and how the product will be sold to the market at what cost. This is known as cost accounting. The management accounting is the blended of financial accounting and cost accounting. This not only helps in taking the managerial decisions, but it also helps to do the forecasting and helps us in knowing what are the cost cutting process where we can increase the process where we can increase the profit and loss of the business and how to reduce the cost of the product. Financial accounting deals with the journal entry, ledger posting, trial balance, and final account, whereas the cost accounting deals with the cost sheet, job and contract, process costing, or operational costing, standard costing, marginal costing. All these things are covered in the cost accounting. Managerial accounting, as I've earlier told, that it helps. It is a blended of financial and cost accounting. This only helps us in doing the forecasting and a decision making. So for this, we are using ratio analysis, break even point, standard costing, and analysis of financial statement. So, when we are going ahead, the basic terms which we are very frequently using in the sessions are business transactions, entries and narrations, goods, profit and loss, assets, liabilities and net worth, capital and drawings, expenditures, types of expenditures, discount, goodwill, bad debts, debtors and creditors, solvent and insolvent, accounting period, and folios, insurance, and fixed deposit. Business transactions. What is the meaning of the word business transaction? The business transaction is any transactions which occurs in the business or happens in a business is considered as a business transaction, like payment of salary, payment of wages, purchase of goods, sold of goods, goods bought on credit, goods sold on credit, electricity bill paid, goods given as charity. All these things are considered as a business transactions. If we are talking the goods given, I have given a gift to my friend, then this is not a business transaction because that gift is given out of love and affection and there is no monetary transaction involved or no money is involved in this transaction, so it is not considered as a business transaction. Entries and narrations. When we record the transaction in a journal entry form, it is typically a accounting technology or accounting method, so it becomes difficult for a person who don't know anything about the accounts or he never studied the accounts. For them it becomes difficult what is written over there. For example, if we say that goods sold to Mr. A, then Mr. A accounts debit to sales account. This is a business journal entry. And if a person don't know what do you mean by Mr. A's accounts debit to sales account, he never understand. And even it is a problem that when we are writing in a accounting language, it becomes difficult for the non-accounting person to understand. So for making it simpler or easier, we will write a narration after each journal entry, like to Mr. A's account debit to sales account, and below this we will write goods sold to Mr. A. So this helps us to understand what is there in this gentry. Goods. The goods means a thing in which the business is dealing. If I have a textile firm, then the things which are related to the textile industry, like fabric, fabric yarn, colors, colors for the fabric, are considered as a goods for the business. Profit and loss. This is the basic term which we are very frequently using in the accounting, profit or loss. When we earn more than the cost invested, it is known as profit, and when we make overpayment over the receipt, it is considered as a loss. So we have covered business transaction, journal entries. So from here you can see what is there in the journal entry. Now the profit and loss, we have covered this thing also. Now another important thing is assets. Assets, property of any kind owned by the business, is called an assets. The things through which a businessman started its business is known as assets, like furniture, fixtures, land and building, motor car, cash, bank, stock, bills receivable, etc. are considered as an assets. Liabilities, the payment which a business is going to be paid in near future, is considered as a liability, like debentures, share capital, loans, creditors, bills, and outstanding expenses are considered as a liabilities. Net worth, or the owner's equity, which is also known as capital, the amount of fund provided by the properties in a business, is called net worth or the capital also. uh, when we are making this thing, assets minus liability is known as capital, or we can say assets equals to capital plus liabilities. If we are talking about the assets, the property of any kind owned by the businessman is called an asset. There are three types of assets: fixed assets, current assets, and fictitious assets. Fixed assets are those assets which remains fixed throughout the life of the company, is known as fixed assets, like plant, machinery, land and building, furniture and fixtures, motor car, computer, all these things are considered as a fixed assets. Current assets are those assets which can be easily converted into the form of cash as and when required, like stock, closing stock, bills receivable, debtors, cash, and cash at bank are considered as a current assets. Fictitious assets, or we can take intangible assets, are those assets which do not have any physical form, but they are becoming the part of assets, like goodwill, trademark, copyrights. All these assets we cannot see, but we can only imagine there are such type of things which we from which we can earn profit when we are going to sell in future. Now we will start with the concepts of accounting. There are certain set rules or the guidelines given in the business, given in the accounting, which we are used to make the accounting statements or the accounting accounts for to know the financial position of the business. Accounting principles are those rules which are to be adopted by the accounts. Accounting is a language of business. This is generally the guideline for sound accounting practices. Reliable financial statements, general accepted based on measures, valid and appropriate assumptions, uniformity in presentation, validity and appropriate assumption, proper information to all. When we are talking about the concepts of accounting, there are 12 concepts and 4 conventions of accounting. The concepts of accounting are business entity, money measurement, cost concept, consistency concept. Conservatism is considered as a convention. Going concern concept, realization concept, accrual concept, dual aspect concept, disclosure is a convention, materiality is a convention, revenue realization principle or the concept, matching principle concept, and accounting standard concept. So we will discuss one by one in detail. Before that, I have used the word convention. What do you mean by the word convention? Conventions are also considered as a set rules or the guidelines, but they are not as the concept, because these are those things which we are follow from a longer period of time. For example, like nobody has told us that Sunday comes after Monday or Monday comes after Sunday, because this is a universal fact which we are following from a longer period of time. This is known as convention. So the same way in accounting also we follow certain conventions which we are following from over a period of time, that is known as convention. The business entity concept. The first concept is business entity concept. The business and a businessman are both different in the eyes of accounting. We always say, I have my business or I am running a business. That means the business belongs to me. But in terms of legal entity concept, or we are when we are talking about the legal entity, the both the things are different. This concept assured that for accounting purpose, business entity and its owner are the two separate individual identities. Thus, business and the personal transaction of its owner are separate. We cannot intermingle the same thing as the business and the businessman are together. Like, for example, when the business owner invested the money in the business, it is recorded on the liability side of the business to the owner, because this is the responsibility of the business to return back the money invested by the businessman. Similarly, when the owner takes away from the business cash or goods or his or personal use, it is not treated as a business expenses. It is always treated as a drawings. Thirdly, but a very simple or very common example which I am usually quoting when we are discussing the concept of a business entity, that who is the owner of McDonald's? Though we are going to eat the burger in a McDonald's, but we do never concern about who is the owner of McDonald's. We simply eat the burger and come back to our home, because the concern is to go to the McDonald's and buy the burger. For example, if we have any problem with the burger or anything with the burger or any facility which is not provided by the McDonald's, then we will not file the suit to the owner, or we are not going to complain to the owner. We simply talk to the McDonald's that the burger is not good or the services are provided are not up to the mark, because we consider that businessman is different and business are separate. Money measurement concept. The concept assures that all the business transactions must be in terms of money. The first thing is that in business we will record only those transactions which are having a monetary value. In our country, certain transactions are in terms of rupees. Thus, as per the money measurement concept, transactions which are expressed in terms of money are recorded in the books of accounts only, and anything which are not expressed in terms of money, we will not record in the books of accounts. Going concern concept. As the name indicates, going concern concept, this means that the life of the business is perpetual. The meaning of the word perpetual is it is never ending process. This concept states that business firm will continue to carry off its activity for future for a longer period of time. Simple stated, it means that every business has a continuity of life. Thus, it will not be dissolved in near future. This is an important assumption of accounting, as it provides the basis of showing the values of assets in the balance sheet. All the transactions in the business are always recorded on the going concern concept. For example, we all heard about a Dabur. Dabur is a more than 100-year-old company. So when the founder of the Dabur started the business, they will think about that we will start this business for a certain period of time and after that we will close the business. No, they have started the business with a concept that the life of the business is infinite, or we cannot measure the life of the business. It is continued from generation to generation and from years to years. Accounting period concept, this is already we have discussed in the previous slides. The life uh, uh, of any entity is divided into short economic time period on which reporting statements are furnished. So for the period of for the accounting purpose, we will start with the period of accounting period where it starts from 1st April of any year and ends on 31st March of the next consecutive years. All the transactions are recorded in the books of accounting on the assumption of profit on these transactions are to be ascertained for a specific period. This is known as accounting period concept. Thus, this concept requires that a balance sheet and a profit and loss account should be prepared at a regular interval for a different purpose like calculating profit, ascertaining financial position and to determining and to make the decisions what steps should be taken by the business to reduce the cost and to earn more profit, or how to make the product more efficiently and more effectively so that we will invest the minimum cost and earn a maximum return. Accounting cost concept. Accounting cost concept states that all the assets are recorded in the books of of accounts at their purchase price or on a historical cost or on a cost on which the cost of acquisition, transporting and installation, and it is not on the market price. For example, I will make it simpler so that you can understand it very well. If we have purchased a machinery 10 years ago at 10,000 rupees or 1 lakh rupees, we will record in our books of account on 1 lakh rupees only till date, because this shows that the cost which we have invested to purchase that machinery or to purchase a plant. It means that the fixed assets like plant, building, and machinery, furniture, etc., are recorded in the books of accounts at the price paid for them. For example, a machinery purchased by XYZ Limited for 50,000 rupees for manufacturer shoes, amount of 1,000 was spent on the transporting the machinery to the factory site, and in addition rupees 2000 was spent in installation. The total cost at which the machinery is recorded in the books of accounts would be the sum of all the three items, and it makes to 5 lakh 3000. This is the cost is known as historical cost, and it will remains in the books of account at this cost, though we will separate less reduce the cost each year by providing the depreciation on the machinery, but the cost remains the same in the books of accounts. Matching concept. The matching concept states that the revenue and the expenditure incurred to earn the revenue must belong to the same accounting period. As once the revenue is realized, the next is to allocate the relevant accounting period. This means that the expenditure and the revenue realized belongs to the same period. If we are talking about 1st April 2024 to 31st March of 2025, then the expenditure and the revenue both belongs to this specific period only. We cannot change the change the accounting period, that we will take the expenditure of 2024-25 and the revenue of 25-26. This is not at all sorry. This is not considered as a matching concept. Matching concept implies that all the revenues earned during the accounting period, whether received or not received during the year, are all costs incurred, whether paid or not paid. The year should be taken into account while considering the ascertaining the profit or loss for that year. Dual aspect of accounting or dual concept of accounting. When we are talking about the dual aspect, dual means two. Every business transaction has two impacts, or we can say has a two sides. Like a coin has a two sides, one is head and another is tail. So every business transaction also have a two aspects. The dual aspect is the foundation or the principles of accounting. It provides very basic of recording business transactions in the books of accounting. This concept assures that every transaction has a dual effect. It affects the double account in a respective opposite side. Therefore, the transaction should be recorded at two places. It means both the aspects of the transaction must be recorded in the books of accounts. For example, goods purchased for cash has a two aspects: cash received and goods purchased for cash. So cash given and goods received. Therefore, or these two aspects are recorded. Thus, a dual entry concept is commonly expressed in terms of the fundamental accounting equation, that is assets equals to capital plus liabilities or liabilities plus capital. When we are talking about this thing, so this means that the cash is considered as an asset. So assets reduces because we have given the cash, and good received is increasing our stock. So in this particular transaction, only assets get affected. In another transaction, like goods purchases from Mr. A, so here the A is the liability of the business because it is considered as a creditor. So liabilities increases and goods received, so the assets increases and the liability increases. This is always that accounting equation will balance assets and liabilities both increases, so the accounting equations remains the same. Realization concept. This concept holds to the view of profit can only be taken into accounting when realization has occurred. According to this concept, revenue is realized when the sale is made. The sale is considered to be made at the point when the property is goods passes by to the buyer and he become legal liable to pay. This concept says that when we are making any sale or we are giving that anything to any person or any business, we will in a position to earn money from them. This is known as realization concept, because until and unless we are not in position to give anything to anybody, we are not able to earn revenue. A revenue is said to be have to be realized when the cash has been received or the rights to receive the cash on sale of goods or services or both has been created. Now, conservatism. Conservatism means that it is a convention. The conservatism is based on the principle that anticipation no profit but provide all the possible losses. We will record only those transactions which have to be occur in present. For example, it provides the guidance for the recording the transactions in the books of account. It is based on the policy of playing safe in regard of showing profit. The main objective of this convention is to show minimum loss, minimum profit, but profit should not be overstated. If the profit shows more than the actual, it may lead to the distribution of dividend out of the capital. This is not a fair policy and it leads to reduce the capital of the enterprises. For example, I am using a very simple example that we are going to receive a money in the month of August. We will not record the transaction right now, because when we receive the money in the month of August, then we will record. This will show the real picture or the real position of the cash. But we there are certain expenses which are going to be happen in the month of September. We know that we have to pay certain dividends or certain taxes in the month of September. So we will record that transaction right now just to make the provision and we will get ourselves prepared for that loss. So this shows that the conservatism, that anticipation no profit but provide all the possible losses today. Consistency. The convention of consistency measures the same accounting principle state to be used for preparing the financial statement year after year. Consistency means that once we have followed one system of accounting or the method of accounting, we will follow the same for a longer period of time. We are not going to change frequently. That this year we will use one third and another year we will use another method. This is not an easy way or the right way to prepare the account. The second problem is that on this method we cannot calculate the actual profit or loss earned by the business during the previous years. So to make a comparative statement or to know the real financial position of the business, we will follow the same method for a longer period of time. And this convention also based on the concept of going concern concept. Materiality. As the name suggests or the name shows, what will be the material impact on the business? We will record only those transactions or those things which materially impact the business. The convention of materialist states that to make the financial statement meaningful, only material effect, that is important and relevant information should be supplied to the users of accounting information. The question has arises here is what is material fact? The materiality of the fact depends on the nature and the amount of money involved. Materiality fact means the information of which influence the decision of its user. Like when we are using the method of depreciation, in one year we will use the straight line method of making the depreciation, and another or after certain period of time we will use the diminishing value of method for making the depreciation. So we can change the method. It is not at all mandatory that we will not change the method in near future, but we have to clearly shows in the business what will be the material impact, why we are changing the method from straight line to diminishing method, and when we are changing the method what will be the impact on the business, whether the straight line will earn more depreciation and the diminishing value method earn less depreciation and less amount of depreciation, and what will be the profitability of depreciation on the business. We have to display that thing in the business. Inflation accounting. The definition of inflation accounting states a state in which the value of money is falling, that is, that is the price or arises. A process of stability arising prices result in diminishing purchasing power of a given simulation of money. Objective: the user or the decision maker gets the information which shows that the performance. To facilitate the comparison of performance of two different periods, it is necessary that the figures are adjusted for the inflation. Monetary items, income and expenditure do not show the correct purchasing power of money, therefore their value should be adjusted. The advantages of inflation accounting: it enables the maintain the capital uh, interact, which is essential in the liability limited liability business. Profit and loss is determined by matching the cost with the revenue at the current value, which is comparable. The asset shows the real value uniform instead of distorted value. The union employs shareholders and public not mislead by giving the exaggerate figures of the profit. There will be a specific figure which shows that what will be the profit percentage or the real value of profit. By showing the current value of the fixed asset, it enables the establishment of realistic price of for the company's shareholders. So this way we can help us in knowing what will be the profitability of the business, what will be the current value of the assets, and how we can use the inflation method of accounting to provide the actual figure or the true figure of the accounting. This way, we will come to the end of first unit where we have covered all the topics from the definition of accounting, importance of accounting, bookkeeping, basic terms of accounting, and the concepts and the conventions of accounting, which helps us in understanding more about the accounting in the coming session. Thank you.